Good morning, everyone. We'll go ahead and kick things off here. My name is Gary Sarkisian, and I'm the Director of Education and Content at CFA Society Boston. I'd like to thank you all for joining us this morning. In a moment, I'll introduce you to today's speaker, but first I would like to highlight some upcoming webinars that we're hosting over the coming weeks. First off, on June 3rd, we are excited to welcome Kathy Wood, CEO and CIO of ARK Invest, to discuss the disruptive innovation taking place in biotech and genomics. This will be an especially important topic given the race to find a treatment for COVID-19. Then on June 8th, we'll be hosting a webinar on the topic of shared caregiving at home, a presentation by the Boston College Center for Work and Families. And last but certainly not least, on June 24th, we will be hosting a webinar on the outlook for commercial real estate featuring Sonny Kalsi, president of Benthel Green Oak. I would like to highlight that this asset class has been bearing the brunt of the pandemic, with questions raised about its future viability, so you don't want to miss this discussion. For more information about these events, please visit our website at cfaboston.org. Now let's move on to today's program. Those of you that perform financial statement analysis and modeling in your day-to-day roles can attest to the regular use of non-GAAP adjustments by publicly traded firms. While companies may justify the use of these adjustments to help investors better understand their businesses, at times management teams can get creative. In addition, recent research shows that non-GAAP adjustments have proliferated over the years. According to a study by accounting professors from Harvard Business School and MIT Sloan School of Management, non-GAAP adjustments to net income among Russell 3000 companies increased by 33% from 1998 to 2017. How should investors navigate through an environment where management teams may employ levers to hide financial and operational risks? Today's presentation, which is titled Mind the GAAP Gap, will hopefully help us answer that question. Our speaker will explore the pros and cons of the most frequent accounting adjustments, additional improvements that can be made, and which adjustments may actually be most useful to investors. It is my pleasure to introduce today's speaker, Dan Mahoney. Dan is the head of industrials research at CFRA, an independent research firm that specializes in forensic accounting. He joined the firm in 2003 as an analyst covering industrial companies, and prior to that, Dan spent 4 years with Deloitte & Touche's audit and forensic accounting groups. Dan holds an MBA from the University of Michigan and a BA in economics and accounting from the College of Holy Cross. He previously served as representative of the investor community on the Financial Accounting Standard Board's Financial Accounting Standards Advisory Council, as well as the International Accounting Standard Board's Capital Markets Advisory Committee. Before I turn this over to our speaker, I'd like to remind our audience that your microphones will be on mute for the duration of the webinar. At the end of the presentation, we will hold Q&A. If you'd like to submit a question to the speaker, please do so at any time during the presentation using the chat or question feature of GoToWebinar. This presentation will also be recorded, so replay will be available afterwards. In addition, attendees will be able to request a copy of slides to today's presentation, and we'll provide you details at the end of our program on how to obtain them. So without further ado, Dan, please take it away.
In today's presentation, we're going to just walk through a couple different areas of non-GAAP metrics. This is clearly a very vast sort of area, and we only have a limited amount of time, but we'll try to touch on some of the most frequent non-GAAP adjustments and measures, and more importantly, I think, give a sort of overview of how to think about non-GAAP adjustments and whether or not the company's adjusted numbers should be trusted. So to start with, the non-GAAP metrics are something that have been used for a very long time to provide investors with additional information and allow for better perspective. The most common adjustments that we see looking at S&P 500 companies are listed here on slide 3. No major surprises here. I'll show you a little bit here on the next slide regarding some of the statistics. We looked at the S&P 500 in fiscal year 15, and you can see just how common these adjustments are. About 2/3 of companies had an adjustment of some type. About 33% had restructuring adjustments. So restructuring is by a pretty good margin the most frequent adjustment that we'll see. So we'll spend some time on that. And then impairments are the second highest, and you can see the rest of the list here. I think one thing to be aware of, though, is this is the entire S&P 500. I think when you look at specific industries, things like stock-based comp, the add back for acquired intangibles take on a much more significant percentage of the overall number of adjustments. So, for example, if you were looking at technology or healthcare, I think you would see a lot higher percentage of companies that were adding back stock-based comp and or acquired intangibles. So companies have recognized the importance of non-GAAP metrics, and investors increasingly accept the adjusted figures. In corporate behavior, we're seeing a number of questionable one-time items, changes in the business model to match metrics, and then subtle metrics changes where the numbers aren't defined, the adjustments aren't defined the same, but they appear to be the same. The bottom line here is we need to show more skepticism in valuing companies off of non-GAAP figures. The other area of importance, I think, and why everyone needs to be aware of non-GAAP figures, is we put out a compliance and disclosure interpretation on the use of non-GAAP financial measures. It goes into pretty good detail on what the SEC looks for, what they think is appropriate and not appropriate. I suggest anyone with interest go to the SEC's website and review this document. It's pretty thorough and actually gives a pretty good guideline for what you should be looking out for in terms of non-GAAP numbers. And just to give you some examples, after this interpretation was put out by the SEC has come out pretty aggressively over the last few years in terms of flagging companies who may be abusing the non-GAAP rules. This was in January 2017. The company had to pay a fine regarding its use of non-GAAP metrics. And then you can see the other area where you'll see a noticeable uptick in SEC review of non-GAAP is in the comment letters that the SEC issues to companies. These are all excerpts from comment letters, just to give you a sense of what the SEC has been flagging and looking for. And we'll go through all of these types of things, but you can see highlighted here on page 8 that we're talking about individually tailored revenue recognition at Activision Blizzard. And then the other big thing here that the SEC focuses on is the prominence of disclosure. So companies are not allowed to give non-GAAP financial measures more prominence than the directly comparable GAAP measures. So if you're talking about non-GAAP earnings in the first sentence of your earnings release and you don't mention GAAP earnings until page 8, that is not in the spirit of what the SEC is looking for. So even if you agree with the company's use of metrics, it is important to know that the SEC may not agree with you, and you should be aware of appropriate criteria to assess the validity. And so what are non-GAAP adjustments? The first thing is that, obviously it needs to provide value-added information. It also needs to clarify steady state business operations. So, this is probably the biggest issue. Does the non-GAAP adjustment adjust the earnings to what the company looks like in a steady state? I think that's what most investors are trying to get out of this. And then other things that we'll go through in detail: is it presented and defined consistently across time? Does the company treat gains and losses equally? You'll see this as a common theme that we find is a problem in our work. Does it reflect the business model? And does it include enough detail and disclosure for an investor or an outsider to assess the validity of the non-GAAP metric? So the way we'll go through this now is just to go through some of the common adjustments. We'll start with operating items, and then we'll spend some time talking about acquisitions, because that's obviously a major area. So when we talk about operating adjustments, we're just talking about things that adjust the operating earnings of the company. So we'll start here with restructuring expenses. As I mentioned, that is the most common type of adjustment. And as luck would have it, it is also the most difficult to assess in terms of its validity. What is a restructuring versus an operating cost is one of the most difficult things to determine. So it's a very gray area. We generally think that these expenses are appropriately used by most companies, but and it's a big but. It is very difficult to tell when companies are abusing the use of restructuring charges. So obviously the thing you want to look for is how frequent these restructuring charges are. We wrote on a company not too long ago that had an adjustment, a restructuring charge in every quarter in the last 10 years. That is clearly not something that we would just take at face value and adjust out of our models. You want to be skeptical when they're frequent like that. And you also want to look at, how big are the restructuring charges if the company gave some guidance in terms of the amount of restructuring. You'll see a lot of times companies go well over what they initially estimated, and people don't look back at the original estimate of what they expected the restructuring to cost. I think the other thing to think about is what are the margins of the company excluding the restructuring charges, and if they're unrealistic relative to peers, that's another thing to think about. So is it really a restructuring charge if the company is out earning its peers in terms of the margins, or should we be considering a portion of those restructuring costs to be ongoing operating costs? Stock-based compensation, simply an add back to arrive at adjusted EPS or EBITDA. The justification for it obviously is that these are non-cash costs, and then the other big argument is they should be excluded from earnings because the cost of options is reflected in dilution. So the goal here, I think, in terms of understanding this, is not for us to take a position on whether or not you should, take a blanket position on whether or not adding back stock-based compensation is bad. It's a very kind of a nuanced approach, but it is a cost, and it should be captured in some way or another. The other thing to always think about as well is, while some dilution is captured in the GAAP statements, the actual potential dilution is not always calculated by the dilution that's captured in the diluted earnings per share. If a company, and then we'll look at an example where if a company is just substituting cash expenses and using stock-based comp to sort of backfill, that's something that is not really sustainable. And so, you want to look at that, and obviously what the cash cost would be to offset any dilution from stock-based comp. So just want to run through a quick example of what we mean by just getting a sense for what the true dilution of an option program would be relative to what's reflected in the GAAP numbers. So here's an example, Salesforce.com. Clearly, you can see here a massive amount of stock-based comp added back. I don't know that that's a major surprise to anyone that's familiar with the company, but whether or not this is a valid add back is in, what is the true dilution of the stock-based comp. And so what you can see here in slide 14 is that the diluted earnings per share, the diluted shares are only about 13 million higher than the basic earnings per share. So there's very little dilution accounted for in terms of the cost of the options in dilution. So what we do is we go through the footnotes and try to think about, okay, is this a good measure of the true dilution? And I think what you can see here is that the issue is that they have a lot of options that are out of the money. And so obviously when you're thinking about buying a stock, you're hoping it's going to go up in value. And so you have to think about what is the potential dilution if a stock reaches a certain price. And so if you look at a couple of these stock issuances, at the bottom here you can see the exercise price at $80.99. And there's about 5.6 million outstanding, but none of them are exercisable as of the date of this filing. And so none of that is going to be captured in the dilution calculation, which is appropriate. The problem is, what if the stock price eclipses that sort of hurdle? And so what we typically do is look at this and think about, okay, if the stock price hits a certain level, what is the dilution factor? So what we did here is sort of model out different scenarios. And what you can see here is if you assume about a 10% increase in the share price over time, the repurchase, the treasury stock method is essentially what they're using to calculate dilution, which gives you about 5.6 million in additional shares. But the dilution at this sort of assumed higher stock price jumps to 13.1 million. And so, this is just a way we think about it in terms of, okay, look at what the options are, what options are not being included in the dilution, and what has to happen for that to be triggered. And so that's just a way to think about stock-based comp and what the true cost of it is. The other issue with stock-based comp is that we see companies that are essentially, and this is actually very relevant right now because with the COVID-19 related slowdown, we've seen people taking pay cuts, and in some instances are taking pay cuts in exchange for stock options. So this is just an example of a company that excludes stock-based comp from its non-GAAP number. And what you can see is they disclosed in their annual filing a voluntary salary deduction exchange for shares program. So what that means is that people had the option of taking less cash in salary in exchange for options. And now that's just pure on a non-GAAP way of thinking about things. That's just pure profit. It's essentially replacing cash compensation for something that does not cost anything from a non-GAAP perspective. And so just thinking about those types of disclosures, those types of programs, do you really want to trust the non-GAAP numbers? They cannot do this in perpetuity. Obviously, at some point, there's a point at which employees are not going to take stock in exchange for cash. And so, any benefit from this is going to be pretty short-lived. Moving on to the next type of adjustment, pension adjustments. We typically put these into three kind of buckets. There are curtailment adjustments related to pensions, which are kind of one-time gains and losses related to freezing plans or changing plans, generally reducing the amount of benefits available. There are accounting estimate changes. So you're changing certain assumptions around the accounting that you use to calculate pension expense. And then the last thing is a mark-to-market adjustment, which a lot of companies take at the end of each year to mark their pension assets and liabilities to market value. Essentially, with pension costs, curtailment is generally should be considered a one-time item. We typically agree with adjusting out most of these things. I think the key with curtailment, as well as mark-to-market adjustments and estimate changes, is to make sure the company is treating gains and losses the same. So I think here's a good example of what we're talking about here. So this is a company that had a number of pension costs, which related to curtailment of their pension plans. And if you look at the 3 months ended March 2014, they excluded a number of costs from their adjustment from their earnings to get to an adjusted earnings number of 83 cents. The problem was that we found in the disclosures that there was also a curtailment charge in the prior year period. So if you look at the March 31st, 2013 numbers, there's no adjustment for pension curtailment. So what that does is it understates the prior year number and overstates the current year number, because you're adding back a cost where, excuse me, the same cost in the current year is being added back. And so that is inconsistent treatment of the pension curtailment. So that's kind of the first flag here, which is that they're adding back curtailment from one period and not the prior period, which makes it a easier comp. The other thing that we found was that in the March quarter of 2014, they also had a gain related to their pension plans, which they failed to add back. So now you have the inconsistent treatment of not adding back gains, but adding back losses. And now, so you can see this, they finally in the June quarter, so this was all in the March quarter. If you look at the June quarter now, they did start to add back these gains. So they got it right eventually, but it took them a little while to get it right. So you got to watch for the consistency of the treatment. And you can see this is just a quick example of a SEC comment letter related to pension obligations. Company flagged had an add back for pensions, calling it non-cash, and the SEC basically took issue with that, saying that pensions are not non-cash. You have to put cash into the pension plan. So just want to show some examples of these SEC comment letters as they relate to the specific adjustments we're going through. Okay, inventory write-downs is another, or inventory impairment, it's generally called, is another kind of frequent area. Generally speaking, when a company takes an inventory charge, it's an appropriate add back in terms of non-GAAP. But there are a couple things that that people should be watching for. So the inventory obsolescence is a periodic charge that should be incurred pretty much every quarter, relating to potential obsolescence or spoilage of inventory. And what we see often is that companies will under accrue that expense over time, and then suddenly take a massive impairment charge that they then exclude from non-GAAP earnings. And so what that means is they've been over earning by not incurring a periodic inventory obsolescence charge, and then they take this what we call a big bath by writing down a bunch of inventory that should have already been reflected in the periodic inventory accruals. So that's something to watch for. Companies essentially managing earnings because they know if they take an impairment charge on the inventory, everyone's just going to ignore it. So just keep in mind that when a company writes down inventory, think about how they were treating that inventory leading up to the impairment charge. Litigation costs, obviously, generally speaking, a massive legal settlement would be a one-time item. Think about the business model, though. Some business models, are legal costs are just part of the part of the equation. But I think the biggest thing that we see with litigation expenses is the failure to treat legal gains and legal losses the same. So companies will add back a legal expense when it goes against them, but not when they benefit from it. So here's an example of what we're talking about here. In the December 2015 quarter, a company called AECOM, they made numerous adjustments to its earnings and added back something called acquisition-related project and legal matters. However, in that same quarter, they also got about a $19.7 million favorable adjustment that was in their GAAP numbers that they did not exclude. And so the problem here is, again, that inconsistent treatment where they're adding back the expenses to get to non-GAAP, but keeping the gains in that non-GAAP number for what is essentially the same thing, which is a legal expense. So you'll see this as a common theme here, where companies are not treating things the same, taking advantage of adding back expenses, but not treating the gains the same way. Okay, impairment charges, these are generally pretty straightforward. Companies will take impairment charges, but just when you see an impairment charge, just think about what it was for. Think about whether the company is appropriately investing in its assets. You know, it's essentially, they call it non-cash, and the charge itself is non-cash, but it's generally something that the company paid cash for originally. So you want to be aware of, you know, whether the company is essentially not intelligently investing in the assets that then become impaired if these things are frequent. So now we're going to talk about acquisitions, acquisition accounting, and the use of non-GAAP numbers to adjust out the costs, the various costs and accounting nuances of acquisitions is a frequent area for non-GAAP adjustments. So we'll walk through what we look for. The first issue is just acquisition or merger related expenses. Pretty straightforward. Company excludes these because they're considered non-operational and one-time, and so, you know, if an analyst wants to understand, well, what's this company going to look like in a few years? Obviously, the costs surrounding the acquisition are not going to persist. So we generally do not take offense to the exclusion of these costs. But if a business model is just a company where they're constantly making acquisitions, then at some point you have to factor in some level of acquisition-related costs into your kind of future period models. You can't, if the company's relying on acquisitions for growth, then you have to also model in that they're going to be incurring these costs as long as that is their business model. The other thing to think about is a company will often make an estimate of what those acquisition costs are going to be. So if you go back to their original estimate, a lot of times we find the costs go way over the initial estimates, but analysts don't look back and think about, okay, maybe some of these costs aren't acquisition related. Again, just a quick snapshot of how the SEC is looking at non-GAAP accounting around acquisitions. The first example with Barracuda is interesting in that they're basically saying what I talked about before, which is if you have these charges every quarter because it's part of your business model, maybe it shouldn't be a non-GAAP number that you're excluding. Maybe it's just an operating cost. So again, the SEC is looking at some of these same issues. So here's an example of what I was just speaking about, which is this just a normal expense or is it really an acquisition-related expense? So here we have an acquisition that occurred on November 1st, 2017. And then you look at the March 31st, 2020 10Q, and what you see here is that they are still adding back $20 million in costs related to an acquisition that occurred in 2017. So maybe these are valid costs, maybe they're not. The question you should be asking, it should at least raise a thought in your mind to think about, you know, why is this company still incurring costs over 2 years after the acquisition closed, and is this sort of in line with what they had originally told people when they made the acquisition? Because it could mean that the acquisition is just not doing as well as they thought, and they're kind of hiding ongoing costs with these and masquerading them as sort of one-time charges. The other big thing with acquisition accounting and non-GAAP is asset and liability step-ups and step-downs. So the most common one is inventory. So a company makes an acquisition, they mark the inventory to market, and then the next couple of quarters margins are negatively impacted because the inventory is at a very high value. So you'll see that pretty frequently, and generally speaking, that's an appropriate adjustment to make. What we do recommend people look out for, though, again, is consistency of treatment. There are adjustments that can be made that help earnings. For example, if you adjust inventory down, it doesn't happen often, but it does happen. Or if you adjust PP&E down so that the depreciation goes down, these types of things, the consistency of that treatment is important. So a lot of times, again, companies will call out the negative impacts and pull them out of their non-GAAP numbers, but not treat the gains the same way. Contingent consideration in acquisitions, another big area for non-GAAP adjustments. A company makes an acquisition with an earn-out component or something along those lines where you don't know if you're going to pay. And the way the accounting for that works is you create a liability and you mark that liability to market every period to reflect the change in fair value. So that can be a gain or a loss. The adjustments are appropriate in pretty much all cases. However, what we find is that companies will sometimes not do a good job of disclosing the impact of these contingent consideration adjustments. So you can see here an example of a company where they had contingent consideration revaluations every quarter. And in certain quarters, if you look at, for example, Q1 16, which is the first column on the left, contingent consideration revaluation was about 23.6% of the company's operating income. And the company had a non-GAAP EPS number. So you would think that a contingent consideration revaluation of that magnitude would be excluded, but the company did not, in fact, exclude that number. So we think that gain from that contingent consideration should be excluded from the non-GAAP EPS. Intangible amortization, pretty straightforward. You know, we generally don't support adding it back. We think if you're going to make acquisitions, you're paid cash for that company. Adding back the purchased intangibles just sort of makes doesn't appropriately reflect the cost of the acquisition in the company's earnings. Okay, so I'm just going to quickly run through some other types of adjustments. We've focused on kind of the operating items. You know, just given time constraints, we felt that that's kind of where time is best spent. But there are other items to think about. Tax, non-GAAP tax-related adjustments are a major issue. Gains and losses on asset sales, fixed income, debt retirement costs is a very frequent adjustment where a company retires debt and there are one-time costs associated with that. And then derivative-related costs and other financial asset gains and losses if you sell an equity investment or something along those lines. So those are other types of frequent adjustments. And you just want to think about it the same way. How is the company treating gains and losses and things like that? And also, cash flow is also another number that's very often adjusted. companies will back out things like cash restructuring costs, pension contributions, one-time or unusual capital expenditures if you're talking about free cash flow. Factoring of receivables can have a major impact, and then environmental or legal payments that go through operating cash flow. And again, just evaluate this the same as you would when you're thinking about earnings. KPIs are key performance indicators. They really serve the same purpose as non-GAAP figures. We're talking about things like same-store sales, for a restaurant or a retail company, bookings, or users or subscribers, things that aren't GAAP accounting numbers, but the company is showing to reflect, growth in their business or highlight their performance in some other way. So that's just another area to think about. How's the company presenting it? A very important thing to think about is these figures are obviously not GAAP accounting figures. They're not audited. There are not set definitions for how to calculate something like same-store sales or new users on a web platform or something along those lines. So what we want to really focus on when a company presents these types of data points is, have they changed the focus of their presentation to sort of get people to focus more on these kind of non-financial figures? Have they changed the definition, or do they have a definition that's different from their peers, a non-traditional definition? So, if you're looking at a restaurant, if they calculate same-store sales in a different way from all of their peers, you might want to look into why that is and whether or not that's unsustainably inflating the same-store sales figure. And then inconsistent definitions. So what we mean by that is, same company, same-store sales figure, they're changing how they calculate same-store sales from period to period in a way that flatters the number. So you want to watch for that type of thing. Okay, so I'm going to spend the last 5 minutes or so just going through some examples, hopefully give you a sense of what we look for. Some of the same themes we've already covered, and just give you some more kind of real world examples. So let's start with, at a high level, what are we looking for after we've looked at some of the specifics? We're looking for persistent charges that a company is calling special or one time, because if they're happening every quarter, they're not so special. Again, inconsistent treatment of similar items or gains and losses, changes in focus by management, and then non-traditional or inconsistent definitions and metrics. And then another thing to think about is, what's the difference between the non-GAAP result and the GAAP result, and is that difference increasing? And that can be a flag that that some of the non-GAAP numbers are getting unrealistic. Another thing to think about is EBITDA, obviously a very frequently used non-GAAP measure. Look for companies capitalizing more of their expenses. Obviously, if you capitalize expenses, they go into intangibles or PP&E, and then it gets depreciated, which is not included in EBITDA. So here's an example of this. A company was able to start capitalizing sales commissions under a new revenue recognition standard. Now, this was allowable under GAAP because it was part of the new standard, but what the company didn't call out and what people didn't realize was that it flattered margins significantly. So as you can see here in the first line, it shows that sales and marketing costs were significantly lower after adopting the new accounting standard. And what that means is you're capitalizing those costs, so they're not hitting the income statement, and therefore that helps your margin. So you want to watch for companies that are capitalizing more and more costs if they're using measures that don't incorporate depreciation and amortization. Okay, so questionable one-time items. This would be an example of what we would consider to just be an ongoing cost that the company's reflecting as a restructuring charge. So this company took a $1.5 million restructuring charge, and excluded it from their adjusted net income. And in the 10Q filing, when we looked through it, all the company did was eliminate 20 positions. They have 6,600 employees. So the question is the elimination of 20 employees out of 6,600 an unusual or one-time item, or is this just, the cost of doing business? So these are the types of things you want to think about with restructuring charges. And then subtle metric changes. Same-store sales, again, this example here is something to watch for. Each quarter, look at the definition of things like same-store sales. In this example, you can see the company in the span of about 9 months changed how they calculate like-for-like sales 3 times. This is something that happens, a little bit too frequently, and it generally, not surprisingly, is done to flatter the results. This is another example of consistency. Now, this is period-to-period consistency. So this is a situation where a company made a change in how they calculated their same-store sales, but they didn't go back and restate the prior periods. So they realized in the first half of 2017 that they were incorrectly calculating certain same-store sales figures. So they fixed 2017, but they didn't go back and fix the previous periods. So now what you have is a current period, 2017, that you're comparing to prior periods that don't match the methodology being used to calculate it. So always think about, okay, they changed the presentation, but did they also go back and change the historical periods so we have a like-for-like analysis? Another example here of a common theme that I've been sort of reiterating over this is just selective treatment of gains and losses. So this Triumph Group, they took a significant charge related to a program that they were doing with Boeing. It was about an inventory impairment of about $34 million in the March 2016 quarter. Now, you can't see this in the numbers because it's not there, but what you can see here is 2 quarters later, they reversed that inventory impairment into earnings. The problem is they didn't exclude the reversal of that number from their adjusted earnings. So the charge was excluded, and then the reversal, which was a gain, was not excluded. So this is our last example. I just wanted to get in a tax example here. And one of the most frequent things that companies do is they adjust their tax rate to some alternative measure because they don't think the GAAP tax rate is proper. So what this company did here is they reflected their non-GAAP numbers reflected the cash that they paid in taxes rather than the accrual-based tax rate. Some people might prefer this, but the bottom line is that this is not generally, you're then comparing a cash tax rate to an accrual-based earnings number, so it's not a like-for-like comparison. The other thing is that in the US, the SEC has explicitly stated that they do not want these types of adjustments, where you're simply removing a gap for an alternative accounting methodology. So watch for companies that make these types of adjustments where all they're simply doing is saying, we don't like the way the accrual-based accounting works, so we're going to use our own accounting methodology. So that wraps up our prepared comments. I just want to reiterate a few things, then we'll go to the Q&A. You probably heard some common themes here. Unfortunately, there are no kind of set rules. There are an infinite number of ways to present non-GAAP earnings. But again, I think there are some things that you can think about to help yourself. So you always want to look for consistent treatment across time. You want to think about the reasonableness of the adjustments. You want to think about whether the company is treating gains and losses the same way. And you want to just think about whether the costs being excluded or the gains being excluded are really one-time items, or if they're just part of doing business. That's not an easy thing to do, but I think just being a little more skeptical and just thinking about how the company has presented non-GAAP over time and how its peers do it will go a long way to sort of helping you assess whether or not you want to use the non-GAAP figures in your modeling of the company going forward and in your investment process, or if you want to adjust the non-GAAP figures to suit what you think to be a more reasonable look at the results. And that just about does it. I think we can take questions now. I apologize again for the audio situation at the very beginning, but hopefully things worked out and everyone could hear.
Okay, thank you, Dan. That was a very helpful presentation, and it shed some light on some of the, let's just say, accounting shenanigans that can take place in financial reporting. So as Dan mentioned, we're going to switch over to Q&A for the presentation. Now, as a reminder for everyone, if you would like to submit a question to Dan, please use the chat or question feature of GoToWebinar. While we're waiting on some questions to come in, I just wanted to ask you a quick question about management compensation, because having looked at a lot of these companies in my prior role, you know, it doesn't seem unusual that sometimes incentive fees are based off of these non-GAAP metrics. Seemingly raises some flags there. I don't know if you can comment about that. You know, should that raise a double flag when you're seeing both very extensive use of non-GAAP adjustments and the fact that management compensation is tied to those, let's call them core or non-GAAP earning numbers?
Yeah, I mean, I think that's a major focus of what we do. You know, to the extent that managers are benefiting from excluding certain items, we want to place additional focus on those items. You know, it's not uncommon for things like acquisition costs, you know, to be excluded from earnings when calculating management compensation targets, which, you know, can incentivize, you know, bad behavior in terms of making acquisitions that aren't in the best interest of investors. Other types of costs, you know, you know, so yeah, thinking about how these non-GAAP figures impact management compensation is very important. And you know, it's not a given that the non-GAAP numbers in the earnings release will match what's in the management compensation numbers. So that's another interesting point where you know, we find managers excluding or including certain things in their own calculation of earnings for their comp that, you know, they're not including or excluding in their presentations to investors.
That's super helpful. We have a question regarding the SEC's role in this whole matter, and the question is, given the growth of non-GAAP measures, are there plans by the SEC to make viewing these adjustments easier to comprehend and understand for retail investors? I mean, there's a lot of stuff to remember there, and your average investor can, especially when you're trying to compare one company to another, can get lost amidst all the adjustments, particularly considering the fact that, as you mentioned right near the end of the presentation, that some of the definitions for certain KPIs, like for like sales, can change over time, and you wouldn't know that just looking at the disclosures in one particular quarter. So what is your view as far as, or is there any kind of sense on any further steps that the SEC will take to help simplify the reporting?
I think, you know, I'm not aware of any additional steps to simplify the reporting or restrict it. They're very careful to not kind of restrict the company's ability to kind of portray its financial performance, you know, within the kind of current parameters as they kind of see fit, kind of a freedom of expression type of thing. So I think other than I guess that, you know, there have been, you know, you had Regulation G a while ago, and then you have this more recent 2016 the thing they put out in 2016, which kind of gave guidelines, but I don't anticipate them coming up with any additional hard and fast rules to sort of force companies to define things a certain way. I think what they are trying to do is push to get better disclosure around these things. Making companies define things better. But I don't think there's any plan to say if you're Starbucks that you have to calculate your like-for-like sales a certain way. Now there is actually some industry and trade groups. So if you think about REITs, they have these FFO figures that are kind of the standard non-GAAP disclosure that they report, and there is a trade group that gives guidelines on how they think it should be presented. So there are trade groups and things like that have stepped in to sort of fill that void, but there's no kind of legal requirement that a company follow what the trade group says. It's just sort of a suggested guideline. But I think as an investor, you can make yourself aware of that, and then kind of try and figure out if the company is sort of diverting from that suggested process, whether or not you're comfortable with how they're doing it.
Right. Yeah. Real estate definitely stands out, particularly REITs definitely stand out as kind of an oddball group that necessitates those adjustments, just given the nature of how depreciation is treated in that space. But on that note, speaking of industries, we have a question actually regarding international companies or companies that have global operations. Do you have a view on non-GAAP adjustments for foreign exchange effect? And the second part to this question is, are there industries that, quote, push the use of non-GAAP measurements further than others that raise your concern? So it's a two-part question.
Yeah. Yep. So the foreign exchange, I think if it's a a derivative, so there are so many different types of foreign exchange. Where we would kind of agree with adjusting GAAP is if it relates to like a derivative position where you closed it out early for some reason, you had a massive gain or loss, or foreign exchange derivative, or a one-time kind of asset sale or something like that, where you have foreign exchange gains or losses. That's a relevant sort of valid add back. Where we generally take issue with companies is the simple translation impact of foreign exchange, which means your local operations are in in euro, and you have to translate those financial statements to US dollars. Some companies will back out that entire kind of impact from translating the foreign currency into US dollars, but again, that's something that has to happen every quarter or every year, so that we would disagree with. So it's sort of, if it's related to the sort of ongoing operations of something the company has to do every quarter with foreign exchange, we would not adjust for it. If it's sort of a one-time transaction where the company is engaging in something that's not part of its normal processes, then we think it's okay to exclude it. And then the second part of your question was on industries. Yeah, I mean, I think clearly, if you're talking about tech and healthcare, I think would be the two most prominent, where you see the largest adjustments in terms of things like stock-based comp and intangible asset amortization, just due to the nature of those types of businesses. You think about the valuations that some companies would command in an acquisition. There's no real assets. You're going to have an awful lot of intangible amortization in those situations. You're also talking about companies where people either want a stake in the business, or the companies just don't have a lot of cash to pay people in cash. They're going to be issuing a lot of options as well. So I think those two areas are probably the ones where you see the the most frequent adjustments of non-GAAP. And then I would say the same for the KPIs as well, especially in tech. You think about some of the classic cases of companies inventing metrics for investors to focus on, like eyeballs on our website, or things like that, where they're going outside the confines of financial reporting to highlight the performance of their business. So I think that also lends itself to an earlier stage kind of new business model type company, which you would generally see in tech.
Got it. So we're coming close to, we're actually at the end of the hour, but we're going to try to squeeze in just a couple more questions for the audience here. So one of them has to deal with, this again, talking about the topic of foreign companies. You highlighted many non-US based companies with the issues going on with Chinese companies, and I think the standout example more recently is this coffee chain in China. With issues going on with Chinese companies trading in the US, should we read into any potential issues with these companies? Should investors, I guess another way to think about the question is, should there be any kind of healthy skepticism towards firms in rapidly growing markets that are not under the purview of the SEC? Because a lot of investors today, US-based investors, are not just investing within the US, but they're investing outside. And are there any potential markets where you have to kind of tread carefully?
Yeah, I mean, I think any of these sort of emerging markets. So there's kind of two different issues there. One is, you're talking about companies based in markets. There's kind of two areas. Are you investing in companies based in, say, China that are listed in the US, or are you talking about directly investing in, say, the Malaysian stock market? I mean, I think in some cases, the first instance where you're talking about a company that's listed in the US, I think the issue is that there's some perception of relative safety because it's listed in the US. And I think, to some extent there is some additional comfort there, but they are not subject to the same regulations as a US-based, US-listed company. They're not, you have issues with the auditing of a company based in an emerging market. There's been a lot of talk about, access to audit papers of Chinese companies and things like that. So if you're talking about US listed companies, I think there should be a very healthy dose of skepticism there. If you're talking about investing directly in emerging markets, I think certainly, I don't want to, without mentioning specific countries, because I'm not an expert in all of them, but I think there is not the same rigor in terms of the reported, and this goes beyond GAAP, non-GAAP. This is just the reported results and how reliable they are. I think you would have to have a very healthy amount of skepticism there.
Okay, great. We're going to go ahead and we'll just squeeze in one more question here, and then we'll wrap it up. And this one kind of just deals with the level of discretion that management teams have. The question is, in terms of management judgment and opinion on allowance or impairment estimates, how much leeway does the SEC give? Does the SEC investigate, and what is its impact on the companies in terms of fines? In other words, are these just, when the SEC response to these companies, are they just minor slaps on the wrist? And if you're a manager running a company, I mean, is there a lot of wiggle room that you have that can kind of skate under the radar?
Yeah, I mean, I think there is a lot of wiggle room. The accounting for allowances and impairments and things like that, accounting in general relies on a significant amount of estimation and judgment, and I think that naturally allows for a good amount of wiggle room for companies. I mean, I think the first check on sort of the reasonableness of those assumptions is obviously the auditor, not the SEC. The SEC doesn't look at everybody, you know, and oftentimes the SEC will step in after the auditor or the company itself has identified an issue and they have to restate or something like that. So I wouldn't necessarily think about the SEC as the sort of person that's policing the accounts on a regular basis. I would think more along of the auditors as it being in that role. But you know, I think whether or not there is an appropriate penalty for cases where companies are caught doing things wrong, whether it's non-GAAP related or otherwise, I think it's fair to say that there could be an attitude among managers to say, hey, you know, even if we get caught doing this, the penalty isn't that severe. We'll pay a couple $1 million fine and move on. So I think there is that sort of there is that potential perception. Now, you don't want to be the person that's that's doing that, thinking and then you're the one that's made an example of by the SEC, because they are increasingly going after individuals. So I guess, you know, I think there is a certain attitude among certain management teams that, hey, let's push the envelope, and, you know, we can, even if we get caught, we restate and maybe pay a small fine. You know, so I think that is a problem. But the SEC, you know, there are certainly cases where they've come down pretty hard on people, individuals, and companies.
And not to editorialize here, but, you know, I would also add that I think it's also important that the investment community holds these companies to a stricter standard. When you have, you know, the street essentially, you know, taking management teams for their word, and these management teams go out and visit with their investors, and they're not being called to question on these adjustments, they feel like they can pretty much keep doing what they're doing. So there's many pieces to this, but I think we'll go ahead and you know, this was definitely a great discussion. I think we'll go ahead and wrap up everything as we're already past our schedule here. Before we sign off, Dan, are there any final comments you would like to make for our audience?
No, I think, like you said, it's just be skeptical and just dig in a little bit more than you have, and I think you'll find a lot of information. And I think one last thing is the slide that's up right now gives you information on how to contact us if you have any additional questions or would like to follow up in any way. And that's about it. Thank you so much for the time. This was great.
Well, thank you, Dan, and thank you to CFRA for agreeing to do this presentation for our society. As I had mentioned at the beginning of this program, a replay will be available shortly after our session ends here. You have the information on how to obtain the slides for this presentation. You can email cservices@cfraresearch.com. For information about our upcoming programs at CFA Society Boston, please visit us at cfaboston.org. Thank you again, and we hope you enjoy the rest of your week. Take care.